Hello, this is Grace Nasralla starting another series of business tips. And today I have with me Baqar Bhatti, the CEO of PAZ, and he is going to provide us with some dividend and salary income tips. Thank you for being with us, Baqar.
Thank you, Grace, for inviting me to this session.
Um, what general considerations are relevant to decide whether to draw salary or dividend income from your CCPC?
Thank you, Grace. It's a very important question because once we run our business through a Canadian controlled private corporation or CCPC, that is generally a family owned business, and of course, the company's shares are not listed on the stock market. So, our primary consideration is that probably we need to have a regular source of income. And then there may be some other periodic income. So when it comes to regular source of income, people usually prefer salary income because we know that we can, directors of the company, we can draw salary on a monthly basis or even on a fortnightly basis. But dividend income is usually, dependent upon the availability of profits, and that can only be known if you have your annual or biannual accounts ready with you. So it all depends upon you. If you're looking for a regular source of income, you may prefer salary income, but then there are related consequences like that. Once you draw salary, there are rigorous reporting and requirements by the CRA, like for example, CPP contributions, employment insurance contributions, and of course, deduction of advance tax and all that. While in case of dividend income, these requirements are not present. So what you can do is you just draw your dividend income at periodic intervals, say normally at the end of the year or say once in 6 months time, and then that would be pretty easier for you. So just to cut it short, primarily it all depends upon whether you're looking for regular source of income or periodic source of income. If your answer is regular source of income, go for salary. Otherwise, dividend income may be a better option. Now, if you have any other question, please move forward.
What is the difference between eligible and non-eligible dividends for owners of a CCPC?
It's a good question because normally what happens is that when we draw income as dividend, our consideration is whether we can reduce our tax liability as compared to salary income. Well, it all depends upon whether you're drawing eligible dividends or non-eligible dividends. In very simple words, what are eligible dividends? It is that amount of income of your Canadian controlled private corporation that is above $500,000, and there should be a balance in the general rate income pool of your company. So any income beyond $500,000, you can pay eligible dividends from that income of your company. But anything up to $500,000, you can only pay non-eligible dividends. The reason being that for eligible dividends, the tax credit rate is higher. So it means you have lower tax liability. But while for non-eligible dividends, the tax credit rate is lower. For example, for year 2019, for eligible dividend, the federal tax credit rate is 15.02%, while for non-eligible dividend, it is 9.03. So, this is one important fact that everybody should keep in mind when they have to, decide whether they would go for drawing salary income or dividend income. I hope it explains everything.
Mm-hmm. Yeah. What tax tips would you offer to owners of CCPCs in relation to salary versus dividend income?
Okay, this is related to what we have been discussing so far. So I'm going to demonstrate that what would be the tax consequences in relation to a simple illustration. For example, there are three individuals, Mr. A, B, and C. And we assume that Mr. A is drawing salary of $50,000, while Mr. B is drawing non-eligible dividend income of $50,000. And while Mr. C is drawing eligible dividend income of $50,000. So, both have the same level of income, but they are coming from different sources. One from salary, other from non-eligible dividend, and other from eligible dividend. If you just look at the contents of the slide, the federal tax payable for salary would be around $5,637. That comes to effectively 11% marginal tax rate. At the bottom of the slide, you can read that. While for non-eligible dividend, the tax liability, federal tax liability, is only $1,306. That comes to about 3% of your income. Whereas in case of eligible dividends, it is zero. So, I mean, the quick conclusion that we can draw is that, broadly speaking, dividend income results in lower tax liability, while salary income results in higher tax liability. But this example relates to a single individual. In real life, you may be a married person, you may have multiple sources of income, so there could be several other considerations that you need to keep in mind.
Thank you. Thank you very much, Mr. Baqar, for the insight that you have given us and the advice.
My pleasure.
That concludes our time, and I will be with you sometime soon with more business advice and business tips. See you next time.